Good morning, good afternoon, everyone. My name is James Bogart. I'm CEO and President of Bogart Wealth. Today's talk is going to be on Roth versus traditional 401ks and IRAs. I do have my question and answer box open as well as the chat box open. So as questions come in, please feel free. And I wanted to start a little bit today, just introduce who we are. So Bogart Wealth is a registered investment advisory firm. We're managing approximately $950 million of client assets. It's about 700 households, and about 90% are major oil company employees, most of which with ExxonMobil. We are true fiduciaries for our clients. Means we're legally obligated to put our client interest above our own. There are actually 19 of us on our team between our advisors, our staff, and then our tax team. We've got 3 offices, one up in McLean, Virginia, one in Houston, Texas, and then one in the Woodlands, Texas. Our mission is to help our clients achieve financial peace of mind by preserving and maximizing intergenerational wealth. Your kids and your parents are some of the largest variables to anyone's financial plan. We've made it part of our firm's culture to give you access to certified financial planners and give your children access to certified financial planners. Bogart Wealth's core competencies are financial planning, investment management, tax optimization, and tax preparation. Not that we feel that any one of the 4 are more important than the other. We do believe that they all need to be seamlessly integrated. And that's going to be part of the overall planning process and obviously very pertinent to today's talk as we talk about Roth versus traditional IRAs and 401ks. One of the calls, got sticky with the fingers. One of our calls to action from any of these events is to actually sit down and run your numbers for you. Absolutely no cost, absolutely no obligation. If you haven't taken us up on the opportunity to do that, I highly encourage it. Really is a very detailed analysis of your situation, and it allows you to see a baseline of where you're at and also get to know our firm a little bit along the way. Today's talk, Roth versus traditional 401ks and IRAs, is part of our retirement readiness series. We actually have 8 kind of foundational events that we do, and within that list, we've obviously done different talks in addition to help supplement some of these topics as things are coming up and needing to be a little bit more timely. We do one on the retirement planning timeline. We do one on retirement income planning, one on Social Security and Social Security strategies, one on tax planning as well as tax law changes, and we also get into some tax optimization strategies. Talk about estate planning strategies, one on net unrealized appreciation and post-retirement income strategies, one on long-term care and long-term care insurance, and then obviously the talk that we're going to be doing today on Roth versus traditional IRAs and 401ks. This list was generated by our audience. If there's a topic you'd like to hear us talk on, delighted to do it. I'm happy to build a seminar or just even spend some time, do a town hall, whatever it is, more than willing to add it into the list. All right, so let's jump in today. We're going to talk a little bit about the basics of what an IRA is versus a Roth IRA. We're going to talk about some of the general conclusions, and then we're going to get into some more specific situations. So in order to understand the difference between Roth versus traditional, we have to talk about this concept of pre-tax versus after-tax, and then also tax-deferred versus tax-free. We'll talk a little bit about contribution limits, some of the penalties and exceptions to taking money out of those types of accounts, and then the implications with required minimum distributions. So at the very high level, any money that's going into a traditional IRA, traditional 401k, all of that money is going in on a before tax basis, unless you decide to put some money in on an after tax basis. But the money is growing completely tax deferred, and when you take it out, you pay ordinary income on the benefits. Whereas with Roth, as well as Roth 401ks, you're putting money in on an after tax basis. It's growing completely tax free. And as long as you've attained the age of 59 and a half and that Roth has been in existence for 5 years, you're able to take the gain out as well tax-free. So to kind of illustrate this, we wanted to show a quick example. So let's just assume you're married. Each of you earns $80,000 a year, $160,000 combined. We know that your marginal tax rate in this example, 22%. You have $20,000 to fund in a 401k between the two of you. So if you put the money all into a 401k, you're going to now reduce the taxable income from 160,000 down to 140,000. Whereas if you put the money into a Roth 401k, the same effective amount that you're able to save is $15,600 because you have to pay $4,400 in taxes in order to be able to get the money in there. So just to kind of build a hypothetical on this, let's just assume after 30 years and using 8% returns, your traditional balance, if you continue to save every single year, is going to be $2,265,664. With a Roth, because again, it's an after-tax amount that you're putting in it's going to grow to be $1,767,218. Your savings come from the last dollars that you earn, so your marginal dollars. So the most important point with this example is that if you put it into a traditional, your savings are going to be at the highest marginal bracket. So you're reducing your effective tax rate at that highest marginal bracket. Whereas with Roth, you're putting in on an after-tax basis. All right, so let's build on this a little bit more. Same example, same number. So if it's traditional, after 30 years, you're going to have 2.265 million. With Roth, you have 1.767 million. Now, if after 30 years, let's just say 6% returns, you can actually withdraw from the traditional $164,598. With the Roth, you're able to withdraw $128,386 per year. Now, if your tax rate's 22%, then after the after-tax amount from the traditional is $128,386. So it's 78% of that original balance. Whereas with the Roth, it's the same number because it's tax-free, $128,386. Now, the point here is if your tax rates are identical, there's no difference between Roths versus traditional. But we know that that's not the case. So let's keep building on this example to help illustrate this point. So same numbers, carried them over before. But, is your tax rate really going to be 22%? So if your total income is $164,598, then your marginal tax rate is 22%, but your average effective tax rate is 17.1%. So the traditional amount that you'd be able to take out on an after-tax basis is actually $136,452, 82.9% of the original $164,598. So the point is because our tax structure is progressive in nature, and what that means is that the first incremental amount, whether you're single, married, or head of household, is at 10%. The next incremental amount's at 12. The following incremental amount's at 22. Then we go to 24. Then we go to 32. Then 35. Then 37. What you pay, the effective tax rate, is less than what your marginal tax rate is because of the progressive nature of our tax structure. So realistically, if you're making the decision to give up on the before tax savings, remember, because when you put the money in, it's at the highest marginal bracket versus what you're going to pay when you withdraw it. Well, we need to do a little bit of analysis of your situation to see what's going to make the most sense. But if your tax rate in retirement is going to be lower than where it is today, then it's absolutely going to favor your savings being in traditional 401k. So while you're working, max out the pre-tax amount on the traditional 401k. Income taxes are going to need to rise by about 34% in order for the Roth to break even while you're in, especially if you're in the later stages of your career at higher marginal tax rates. This is a great little chart that Pete built that really helps illustrate this point. And what it's showing on the x-axis is your average tax rate after retirement versus on the y-axis is your marginal tax rate now. And there's a real clear delineation that if your average tax rate, as I made in an earlier point, is the same as your marginal tax rate, there's no difference or no benefit of doing Roths versus traditionals. However, if we know that your tax rate now is higher than what it's going to be in retirement, then without a doubt, it's going to favor doing before tax contributions. And that's exactly what I'm saying here. So if the tax rate's higher in retirement, then it's going to favor saving in a Roth 401k. If your tax rate's lower in retirement, it's going to favor traditional 401k. So think about your household, right? More often than not, anyone who's in their 50s and 60s, they're in the highest marginal tax rates they're ever going to be in. So for them, it really is going to favor taking and saving in the pre-tax environment. However, your kids, for example, who might be in the earlier stages of their career, hopefully going to have some advancement in income and earnings, career advancement, well, it might make sense for them to be saving in the Roth early on. And then at some point, as their income starts to go up, then we start having a conversation around transitioning over and doing traditional savings for them later on. All right, so I already kind of hit this point, but it really is kind of building on that same concept that if, because of the progressive nature of our tax structure, and again, if you're at the 10% bracket, and let's just say married filing jointly, well, we know that any income under $19,750 is at 10%. Now, if you're right at the top of the 12% bracket, your income is at $80,250. Your actual effective tax rate, the average tax rate, is 11.5%. And if you're right at the top end of the 22, so the number is $171,050, well, you're, again, top the 22% bracket, effective tax rate is 17.1%. And obviously, as you continue to go up, your effective tax rate, while you're continuing to pay in taxes, will continue to go up as well. But it's really, really important, and then probably one of the biggest takeaways is somebody's trying to determine where to save while they're still working, is while you're saving, pre-tax contributions occur at that highest marginal bracket, whereas when you're in retirement and you're taking money out, your withdrawals happen at the average tax rate. And so that's probably the biggest part of this to take home. And when you're making the decision in terms of where to save, well, think about where your tax rate is now versus where we're projecting it to be in the future. All right, so let's just talk real quickly about contribution limits. So for 401ks, whether it's a Roth 401k, traditional 401k, you're able to put $19,500 in if you're under the age of 50, and this is up from where it was in previous years. Last year it was $19,000. In 2018, it was $18,500. And you're also able to do what's called a catch-up contribution. So when you're over the age of 50, you can do an additional $6,500 into your 401k. Now, by the way, if you happen to be turning 50 this year, and something that I've noticed with a number of households as they're saving, they think because they're putting a percentage of their paycheck in, that it'll automatically fill that bucket up and start doing the catch up for them as well once they turn 50. That's not actually the case. With most 401k plans, you actually have to go in and tell the plan that you want to have the catch-up contribution done for you. And for example, with the ExxonMobil savings plan, it's a separate bucket. And when you know you're doing it, it's actually specifically listing a dollar figure of what's going in. Whereas with normal contributions, it's done on a percentage basis. So just important to know when you go in there. Now with Roth 401ks in the savings plan, you're actually able to, there is no income contribution limit. So you can make as much as you want, as much as you possibly can, and still put money in on an after-tax basis in the Roth. Now, going back to the points that I've been making for the last couple of minutes, might not make sense if you're in a very, very high bracket. Again, everyone's situation is going to be a little bit different. Now, with IRAs, and this is Roth IRAs as well as with traditional IRAs, you can put $6,000 in 2020, which is up a little bit, same as it was in 2019, but up a little bit from 2018, which was $5,500. Plus, you can do an additional $1,000 catch-up contribution if you're over the age of 50. Now, IRAs, you can actually do, it doesn't matter what your income is, you can do contributions into IRAs no matter what. There are limitations on Roth IRAs in getting these in. So for example, with a Roth, if you make over $206,000 and are married, you're not even eligible to do a Roth contribution. So there's an income phase out that happens. For individuals, it's $139,000 of income. Now, there are no income limits to do Roth conversions. So with Roths, there's two ways of getting them in. This is Roth IRAs. You can do either a contribution or a conversion. So you are going to be capped out based on income if you want to do a contribution, but you can make an unlimited amount of income and do a conversion. So conversion means that you're going to take money from an IRA and convert it over into a Roth IRA. Now, I'll talk about Roth conversions here in a few minutes and some different nuances with this, but it's definitely something from a strategy perspective that we should talk about. Now, you can contribute to both a Roth and a traditional, but you're still capped out at these total numbers. So for example, in the 401k, you're capped out at the 19.5 if you're under 50. So if you do Roth 401k and traditional 401k or before tax 401k, you're going to get limited still at that 19,500. Or if you're over 50, it's going to be 26,000 total. Now, one thing that I see this a lot where people say, oh, well, I'll put a percentage in a Roth 401k and I'll do a percentage pre-tax. It's important to remember, you're going to get capped out at that threshold. So if you're in a high income year or you're in the later stages of your career it might not make sense to have anything going towards the Roth 401k. You can contribute to both a 401k and an IRA. Now, ultimately, your tax situation may or may not determine if you can take a deduction off that contribution into an IRA. But 401ks have higher contribution limits and obviously get the company match. So that's the place that we'd like to see savings happening first. All right, I've had a whole bunch of questions come in, so let me make sure I get these. Is the $19,500 contribution to 401k only for the employee's contribution, or does that include the matching contribution from your employer? No, I'm so glad you asked that question. That $19,500 is just the employee portion. Now, within a 401k plan, you actually can put all the way up to $57,000 in if you're under the age of 50 and $63,500 if you're over the age of 50. Now, what that number means is that's what you can put in. So if you're over 50, let's use the 63.5. If you're over 50, you can put 26,000 in your money, whether it's Roth or before tax. 26 is what you put in. Now, let's say that your employer match, let's just make the math really easy. Let's say that they put in 14,000. So that brings the total balance up to 40. And then you're actually able to come back in and do an additional 23.5 of after-tax money into the 401k. I'll talk about why that makes sense here in a few minutes as well. All right. Does Roth 401k contribution count towards your contribution limits for the year, even though you're not limited from participation due to income? Yes, I think I already made that point. And then another question that came in, is there any pause time required to recommend for conversion or backdoor Roths? I'm not totally sure what you mean by pause, but I have not quite gotten to backdoor Roth conversion strategies or conversion strategies, but no, there's no time limit in terms of from when you put the money into an IRA, you can immediately convert it to a Roth. So for like backdoor Roths, and I'll talk about what those are in a minute, but you can do the IRA contribution in any given year and then immediately convert it over to a Roth. Now, if you happen to have pre-tax amounts sitting in an IRA account and are deciding to go ahead and pay tax to do the conversions, again, the money can be from this year, you can be from 30 years ago. You can still do the conversions. Now, obviously, the pre-tax amounts will create some tax implications. Get a little ahead of myself with that one, but I'll come back to that and hit it a little bit more in a minute. All right, it's important to talk about early withdrawal penalties. Now, with early withdrawal penalties, this is if you're under the age of 59, there is a 10% penalty, and this is applying to both IRAs as well as 401ks. Now, there are some exceptions to this. Now, with IRAs, the exceptions are you can take money out penalty-free if it's for education purposes. If it's for something that's called 72T, which stands for a series of substantially equal periodic payments. So you can turn your IRA account into an annuity stream. It has to be the exact same amount withdrawn for 5 years. Still ordinary income, but it's penalty-free. You can take money out of an IRA account for medical purposes. And you can also take money out for what they call first-time home purchases. Now, the term first-time home purchase is actually a little misleading. Excuse me. You actually can still take the money out if you've not owned a home in 2 or more years. They consider that your first time. So in some instances, you might have, for example, taken an overseas assignment and then come back. Then all of a sudden, you're going to be buying a house. Let's say you were overseas for 2 years and then you needed some money for a down payment. You can actually take it out of the IRA. Again, still ordinary income, but penalty-free. Now, with 401ks, same 10% penalty as I mentioned before. There's actually still the medical exception. There's still a 72T exception. And dependent upon the plan, but for most plans, you can actually still take money out of a 401k once you've attained the age of 55 and separated from service. Now, like for example, with the ExxonMobil plan, you can take it out once a year, penalty-free, still pay ordinary income. But for those that are trying to bridge the gap from 55 until 59 and a half, one of the ways that I actually really like to do that is actually with leaving the savings plan at Voya and then ultimately looking at that as the option to take the money out once a year. So we have to do a lot of budgeting for what the annual expenses are going to be, but then we can take the money out, we'll pay ordinary income on it and use that for cash flows for the year. And then as soon as the calendar year resets, we can do it again. Still somewhat restrictive. And obviously if we have surprise expenses come up, need to be mindful of that, but it is something we're able to do. All right. most important part of this is, especially if you're under the age of 59 and a half and we're trying to bridge that gap, we need to have a withdrawal strategy in place to be able to get there. All right, now required minimum distributions. This is our probably, for most households, our least favorite thing. Now, what a required minimum distribution is when you turn the age of 72, you are required to start taking out a percentage for each year of what your previous year's IRA account balances are, what are called qualified account balances are. Now that percentage increases every single year. I'll show the table here in a second. You obviously can take more out, but you have that minimum amount that you need to take out. Any amount that you miss has a 50% penalty, plus you have to pay ordinary income on it. So it can be extremely steep. Now, RMDs count towards traditional IRAs, they count towards traditional 401ks, and they count towards Roth 401ks. RMDs do not count towards Roth IRAs. So it's important, and anyone who has Roth 401k money, once you hit that age of 72, we need to make sure that we've at least rolled the savings plan out of OIA then, because there's no point in taking an RMD on a Roth 401k when we could just roll it into a Roth IRA and not have the RMD implication on there. It's so difficult to get money into the Roth environment, as we talked about earlier, between contributions and conversions, that ultimately we want to leave it there as long as we possibly can. Typically, Roths are the last place that we want to be drawing from because all of that growth is occurring on a tax-free basis. Now, here's that table. Now, right now, we actually, there is a proposal in Congress to change the RMD table. It has not been approved. This has been on the table for almost a year now. But the current table, it actually started at age 70 because up until the end of 2019, RMD age was actually 70 and a half. Now, the Secure Act at the end of 2019 revised the RMD age from 70 and a half up to age 72. That's why I mentioned 72 a moment ago. There's very few households at this point who are still trying to manage RMDs that aren't in that category where the age didn't move up. But the point is that if you start at 72, the percentage you're required to take out is 3.87%, 3.9, we rounded it up. And that percentage increases every single year. And what we find is for a lot of our households who ultimately have been fiscally conservative their entire lives, all of a sudden, especially when they get into their 80s, these percentages can actually be pretty heavy, where it's forcing you to take more out. And again, because IRAs and 401ks are ordinary income, when you take them out, it's actually forcing your taxable income higher. And the point is we want to be able to have flexibility to control what our taxable income is going to be as best we possibly can, and ultimately mitigate what the implications would be. But the way the table structures, that percentage is increasing every single year. If you're fortunate enough to live to age 115, you got to take out 52.6% of whatever the IRA account balance is. Obviously, I hope you live to 115, but the point is that percentage is increasing every single year. Quick question. Did some of these exceptions to the 10% penalty for withdrawals from the 401k also apply to withdrawals from the pension? Great question. So the answer is yes, but no. So with a pension lump sum option, you obviously have the ability to take a pension. And so there's not going to be an early withdrawal penalty on a pension payment. But if you decide to take the lump sum and you're under the age of 59 and a half, that lump sum will go right into an IRA account. And that IRA account penalties and exceptions will be, as I mentioned earlier here. So if you take the lump sum, it's got to go to an IRA account. And ultimately, the IRA account is going to dictate what the potential penalties may or may not be. All right. Now, we've talked a lot about, 401ks versus IRAs, factors which favor Roth versus favor traditional. Ultimately, we do recommend the first place that we see savings happen is in the 401k, but before we consider doing IRAs or Roth IRAs. And the reason is you get you get the employer match, there's higher contribution limits, and there's potential for doing NUA. We have an entire presentation on NUA and what that means. It's specifically talking about company stock that's within a retirement plan. But with regards to factors that favor the Roth 401k, if income tax rates are going to be higher when you retire than they are now, then we should do Roth 401k. I don't know a whole lot of employees who ultimately their tax rates are going to be higher in retirement than they are now, but there are situations that might be that case. Let's say you've got a spouse who's working and continuing to be in high brackets when you're retired and trying to draw off the 401ks. If you expect your salary and spending to go up significantly faster than inflation between now and retirement, do the Roth now and then ultimately switch to a traditional later. Well, that's the category of your kids, right? If somebody's in a low bracket early on, then that's going to make a lot of sense. Now, if income tax rates all go up in the future, which by the way, there's a high probability of this happening now. Well, we do know based on the 2018 tax reform that rates will go up in 2026 or at the end of 2025. If I were a betting man, I wouldn't be surprised to see tax rates actually going up ahead of that, given the amount of fiscal stimulus that we've had to do over the last 6 months or so related to COVID. Now, also, if you're going to be in what we affectionately call RMD prison or RMD purgatory, what this is we're really going to need to do some analysis of what your retirement account balances are today, what they're projected to be when you're 72 and beyond. We need to look at ways of mitigating the pain of RMDs. And it might be that we look at doing what we call bracket bumping. And I'll talk about that here in a second, and some Roth conversion strategies as well. And then lastly, what would favor doing a Roth 401k is if you anticipate leaving a large legacy to family. And I'll come back to that here in one more second. Compare that to favoring doing the traditional 401k. So if income tax rates are going to be lower in retirement versus now, as I've already talked about, let's do the 401k. As I also have mentioned, the progressive nature of our tax structure, the difference between marginal tax rates and effective tax rates, also favors traditional 401ks. Potential future tax law changes, I think these are less likely, but it is a possibility. If we see a flat tax overall, then that's going to favor traditional. A national consumption tax or a VAT tax would favor traditional over Roth, et cetera. Now, if you anticipate needing to draw down all or nearly all of your retirement savings, in other words, required minimum distributions are not an issue for you, which by the way, this is most of America, then that would obviously also favor traditional 401k over a Roth. And then lastly, if you anticipate leaving a large legacy to charity, so if you're very charitably inclined, also favors leaving a amount to saving in the traditional 401k versus the Roth. Now, I want to come back to that last point, specifically talking about Roth versus IRA. One thing that changed at the end of the year, I already talked about the Secure Act. The Secure Act changed RMD age from 70.5 up to 72. But the other thing it changed is the way that your children will inherit, or excuse me, your heirs will inherit retirement accounts. Now, prior to the Secure Act, you were able to inherit a retirement account, and then the kids were able to stretch it out over their lifetime. So they were able to take RMDs over their entire lifetime. Post the Secure Act, so one of the things that has changed is now they only have a 10-year window to take out the account. So let's just say you're very generous. You leave your kids $1 million IRA account. Well, next thing you know, they've got 10 years to take that $1 million out. And again, it's all ordinary income. So 10 years, just, very simplistically, they don't have to do it over a 10-year period of time, but that's probably the most tax effective way of doing it. It's an extra $100,000 a year of RMDs. Now, if they are typically, most of the time when you inherit these things, you're at the later stages of their careers, they might be in higher brackets themselves. Well, now all of a sudden it's a burden. Let's just say your kids are fortunate enough to be in the 24% bracket, an extra $100,000 in income can easily throw them in the 32. Whereas if we're doing some advanced planning work, and I'm going to get to talking about strategies in a minute, but if we're in a situation where you are going to have an RMD issue yourself, and we're trying to manage tax implications for you, but there's also this peripheral benefit of doing Roth conversions, getting money from IRAs over to Roths in years that you're in low brackets, because ultimately the kids will then inherit Roth or more Roth than they would traditional. Now, inherited Roth IRAs will still have RMDs. They still have to take it out over a 10-year period of time, but it's tax-free. And so a lot of the times the discussions we're having now, which these implications are only happening now for people who passed away 2020 and beyond, but it's telling the kids, hey, look, mom and dad left you a Roth IRA. Let's leave that guy alone for 10 years if you don't need the money. Let the tax-free growth continue to happen. We'll take it all out in year 10. There's no tax implications then. All right. I had another question come in. Do RMDs apply to lump sum pension rollover to Voya 401k savings plan? Yes. So same thing back here. Go back to this slide. if you were to take the lump sum and you were to roll it into the savings plan, which is absolutely something you can do, but again, RMDs will apply to all traditional 401k plans, which the savings plan is a traditional 401k plan. Not something that I typically would recommend, but it's something that you have available to you. Did I understand correctly that if you're over the age of 55 years old and leave the company, that you can withdraw from your 401k plan once a year without a 10% penalty? Yes, you did hear me correctly. That's one of the exceptions for 401k plans listed right here. Over 55 and left the company. All right. Let me dive into some strategy stuff now. All right, so one of the things we want to talk about is surplus RMDs. I'm going to talk about 529s versus IRAs. I'm going to talk about savings beyond the 401k, and then I'm going to talk about inherited IRAs a little bit more detail. So if you live long enough, you're either going to completely deplete your IRAs or you're going to have RMDs that are bigger than what you want to live on. We call that RMD purgatory or RMD prison. You know, for most people, you can take advantage of large RMD surplus to look at what your average tax rate is, and it's going to potentially surpass your marginal tax rates. You know, we model scenarios where we've got clients whose RMD, their tax bill is going to be bigger than what their living expenses are when they're in their late 80s. It's a great problem to have. You're talking about the 1% of the 1% problems. However, I don't know a whole lot of people who like to have effective tax rates that are 50, 70, 80, or even 100% of what their actual expenses are. And so it's one of those things that you need to plan for and you need to model for. So if you're in that position where you have large surplus required minimum distributions, we might want to consider doing Roth 401k now, or we might want to consider Roth IRA or conversions now in years that you're in low now. And it's specifically if you have tax paid. I have a whole presentation on the ExxonMobil savings plan, but if you've got tax paid in the 401k, definitely want to have a conversation around how to manage that, get it over into the Roth so that all of that growth is happening tax-free, especially if you got a couple more years of working, or if you plan on leaving the money in the savings plan. We want to have that conversation because while the tax paid money is sitting in the savings plan, all of that growth is happening on a before tax basis. Whereas if you go ahead and pull it out and get it into a Roth, then the growth is happening tax-free. All right. Another strategy, which is something I'm coming up to, but it's talking about IRA conversions after retirement, but prior to the age of 72. This is without a doubt the best option, and I'll show you an example of a scenario where the customer had a couple years of being in low brackets, and ultimately with doing some bracket bumping and looking at ways of converting from IRA to Roth, we were able to dramatically bring down tax implications. And then also another strategy would be considering gifting now. So early on, go ahead and giving more to kids, charities, et cetera, from IRA accounts. But you definitely want to keep in mind that Roth IRA must be in existence for 5 years in order for that tax-free benefit to accrue. A lot of people kind of seem to miss that. All right. So the decision on converting versus not. So obviously the first thing that we need to look at is, do you think that you're going to be in the same or higher tax bracket when you retire? And if the answer is no, you know, ultimately it's the first leave of this chart. We want to look at doing conversions that are not going to be pushing you up into higher brackets. If the answer is yes, then we need to look at the time horizon. And then ultimately we want to look at what will the implications be of now converting now versus in the future. And then also the conversation that needs to be had around Roth conversions is, do you have the money to pay the tax bill to do the conversion? And ultimately taking more out of the IRA to be able to pay the tax bill, that's obviously going to increase the amount or decrease the marginal benefit of the conversion. So this is where the analysis becomes so important. And here's just an example of one where the client was working. 2020 is an expensive year for them, but they've got some after-tax assets. And all of a sudden, for the next 4 years, they're able to drop into, 5 years, drop way into low brackets. Now, ultimately, as soon as they start taking out of the retirement accounts, next thing you know, they're in the 33% bracket. And that number continues to grow where ultimately at the end of life, they're exposed to the 35% bracket. Again, this is a great problem to have. I get it. But ultimately, with doing a little bit of optimization work, we can enhance the level that's being transitioned to the next generation, while at the same time, too, minimizing the tax implications to you over the next period of your retirement. And so great scenario. This household didn't have a whole lot of Roth. Obviously, they've got some tax deferred assets. But one of the things we worked with them on was talking about doing some bracket bumping or conversion strategies, where what we did in this case was we actually took their marginal tax rate all the way up to the top end of the 24% bracket. And this is, again, it's a hypothetical illustration, but it shows kind of the point. And what it did was it not only increased the amount of money that's transitioning to the next generation, but it transitioned the way that the assets were transferring to them as well, with significantly larger Roth portions. Now, in terms of the benefit to them, it actually had a dramatic impact on reducing their RMDs. So this is, again, hypothetical modeling, future expectations to be. But we were able to actually, in this illustration, decrease the value of their RMDs by 1.688 million. Great problem to have. And the other thing that it really did was it actually dramatically brought down their taxes. So over their lifetime, they actually reduced the projected tax implications to be by about $518,000. So again, just with a little bit of advanced planning work, we were able to significantly bring down the amount of tax implications. Now, obviously, with doing this, we make the decision to pay a little bit of tax now, so their effective rate increased in earlier years. And even in this case, we could theoretically have done a little bit more, but we were trying to illustrate the point mostly. But we did a little bit more, and ultimately, we're paying more tax now, but as I mentioned in the previous slide, significantly reduced the tax burden for them overall. All right, 529s. Get a lot of questions on this related to college and education expense funding. So a 529 is a college savings plan. Now, a lot of people ask, why not save in a Roth versus saving a 529? Now, 529s have a lot of advantages. There's no income limits to doing contributions. There's no tax on withdrawals for qualified education expenses, and the contribution limits are significantly higher for 529s. Now, just to, by way of reference, as I mentioned, if you're under 50, it's $6,000 a year can go into a Roth. If you're over 50, do an extra 1,000. With 529s, you can actually put 14,000 each in to the 529, and then if you're married, you can do it times 2, so 28, and you can actually front load 5 years. Excuse me, I just said 14. It's now 15,000 each. So you can do 30,000 a year, and you can front load 5 years. So you can do 150,000 into a 529 all in one shot. And all of that growth is happening tax deferred. And if it comes out for education expenses, it's completely tax free. Now, there are some challenges here with this. The first is that taxes and penalties are assessed if it's not taken out for education expenses. And it's also considered assets on a student aid application or the FAFSA forms. Now, one of the things I recommend with 529s is that if you're doing this for grandkids, I'd like to see the 529s happen in grandpa and grandma's name, not you giving the money to the kids, your kids, for your grandkids' benefit. There's several reasons for it, because if it's in grandpa and grandma's name, it's not counted on the FAFSA form for the first 2 years. And ultimately, we can kind of transition how we're paying for college to keep FAFSA qualifications. So if the kids, your kids, are in a lower tax bracket, there's some advantages of doing that. But also with grandpa and grandma, they still maintain control, and they can change the beneficiary to be anybody they want. My grandfather is very funny with this. He calls it his worthiness provisions, but some of my cousins weren't exactly worthy as they got to college age, and ultimately he decided to shift the way that he was transitioning 529 support for some of the other grandkids who arguably had a little bit more need. But one of the things we talk about a lot with 529s is let's not overfund these. So we need to model what we're projecting the expenses to be, and then naturally, strategically show where we're saving. All right, so in terms of strategy with this, we want to talk about funding the 529 plan first. We don't want to overfund it, so consider Roth contributions and conversions that can be withdrawn tax and penalty free for qualified education expenses. Once we hit that threshold where we're marginally going to be in between, like paying for out-of-state public tuition versus a private tuition, we can utilize the 529 for the base amount and then use a Roth for the ancillary amount. And the other benefit is that Roth money is not counted on FAFSA forms. All right, let's see. Now, savings beyond the 401k plan. So as I already mentioned, you can do 19,500 into a 401k. Maximum amount is, excuse me, that's a typo there, 57,000 under 50, and then you get to do the extra $6,500 of catch-up contribution. So this goes back to a question that I got earlier. So you can put the $26,000 in on a before tax basis, then the company match will come in, and then you can do extra contributions on an after-tax basis after that. Now, so in terms of contributions beyond the initial base amount, one of the things that we talk about, and someone had already asked this question, is doing backdoor Roths. And so when we talk about contribution limits, it's important to kind of build into what are the implications of doing an IRA contribution versus doing a Roth IRA contribution. So with IRAs, we've already talked about this. If you're under 50, you can do 6,000. If you're over 50, you can do 7,000. There is no income limit to do an IRA contribution if you have no intention of taking a tax deduction. Now, however, if you are going to take a tax deduction, there are some caveats to it. So if you're covered by a plan, meaning you are participating in a 401k plan, your income, if you're married, has to be under 124,000 to even be able to take a deduction. If one spouse is covered by a plan, your income has to be under 206,000 to be able to take a contribution. Now, with Roths, I've already kind of talked about this, but you can do 6,000 of contribution with that additional 1,000 of catch-up contribution, but it's phased out by your income. So again, it's 206,000 if you're married, 139,000 if you are single. Now, there is no income threshold for conversions. So this leads to one of the things that we talk about, which is backdoor Roths. And some people aren't familiar with the term, so I wanted to introduce it. You have the ability, and again, the big caveat here is you cannot have an IRA account with doing this, but you have the ability to do an after-tax, non-deductible IRA contribution, and we call it a pit stop, right into the IRA, and then we immediately convert it over to the Roth. So this is one of the loopholes of being able to get money over into Roth if you're over those income thresholds. So in terms of savings priorities, one of the things that people always ask us about is, where should I save first? Well, I'm going to go back to a comment I made several times today. I want to see you max out the 401k plan first. Then we need to talk about where to save after that if you have the ability to do that. Next place I'd love to see, if you don't have any IRA accounts, is this backdoor strategy. If you're over 50, $7,000. Today is the cutoff day to do 2019, so I wouldn't say you really have the ability to do that anymore, but we could still do 2020. You have all the way until April 15th to do the previous year's return. Now, after that, so if you've done the pre-tax amount, then you've done the backdoor strategy, and if you can still save, then I want you to come back and do the after-tax that's within the 401k. Does provide a lot more flexibility. It gives us a lot of the latitude to have different strategies, different investment options as well. And if you are fortunate enough to have accumulated tax paid within the 401k, let's also have a conversation around what the most effective thing to do with that is, because you do have the ability to withdraw it once you've retired. You have the ability to roll it to a Roth IRA, and you have the ability to apply it towards the cost basis for any shares that we're going to declare for net unrealized appreciation. I've covered all of these things at some of the other webinars that I've posted online. So if you'd like to talk about it one-on-one, I'm happy to do it. But also, if you just want to watch some of the other webinars, you can watch those as well. All right. Now, when we talk about beneficiaries, and I already kind of hit this point, but beneficiaries after the Secure Act have changed dramatically, so that now we've got three categories of beneficiaries, what we call eligible designated beneficiaries, and non-designated beneficiaries. So an eligible designated beneficiary is a minor child of the decedent as long as they're under the age of 17, a disabled person, chronically ill person, someone who's not more than 10 years younger, a spouse, or certain types of trusts. None of the rules changed here. They're able to still stretch out the provision over their lifetime. Anyone who falls into the category of a designated beneficiary, so this is non-spouses and certain types of trusts, these would be your kids, any other heirs that ultimately, yes, they're going to inherit these. They've got to take everything out over a 10-year period of time. And then the third category is if you don't list somebody, or it's charity, your estate, or other certain types of trusts, they actually still, those rules didn't change for them either. They've got to take everything out over a 5-year period of time. So it's important when it comes to beneficiary designations that we have a discussion. It's also important to talk about, if we're going to use a trust, the types of trust, and making sure the correct language is in there as well. All right, one other piece on this. So your Roth IRA does not have a required minimum distribution, but your inherited Roth IRA does. So if you're leaving the kids Roths, important to know. And I typically recommend in an estate plan, if there are Roths, make sure the kids know, especially if they don't have an advisor helping them, leave the Roths alone if they can afford to do so. Let them get additional 10 years of tax-free growth out of them. With spousal beneficiaries, they have the ability to choose, they can either roll to their own Roth IRA. They can treat it as an inherited Roth IRA, no 10% penalty, no 59.5 issues. Now, non-spousal beneficiaries, they always are treated as inherited Roth IRAs or IRAs. And ultimately for them, they've got to take it all out over a 10-year period of time. Now, withdrawals from an inherited IRA or Roth IRA, they can happen at any time. There is no 10% penalty if they're under the age of 59.5. And as I mentioned earlier, eligible designated beneficiaries can choose their RMD based upon their own life expectancy. Everybody else has the 10-year window that they've got to take it out. And this is where inheritance planning, estate planning is important, and talking about how you're transitioning wealth. Now, when it comes to inheriting traditional IRAs, same as the Roth, except for they get to pay taxes on them. Now, there is a lump sum distribution. They can take it all out as a lump of cash. Spousal beneficiaries, they have the ability to roll it to their own, and they can take it out on their RMD schedule. So if they're younger, that's probably going to make sense for them. They can also treat it as an inherited IRA and follow an immediate RMD schedule. And then non-spousal beneficiaries, if they're eligible, they can do RMDs over their life expectancy, but that must begin in the first year. And if not, they don't fall into that and they're just a designated beneficiary status, they've got to take it out over a 10-year period of time, as we've already discussed. So point is, there's a lot of factors that come into this discussion around traditional versus Roth. We need to look at current marginal tax rates versus future average tax rates. We need to look at what your Social Security timing might be and what the implications are going to be from a cash flow perspective. We need to look at savings while you're working, tax qualified versus after tax account. If you're in the position where RMDs are going to be a burden for you, want to make sure that we're planning for that appropriately, address any future tax law changes, and then obviously incorporating estate and estate planning changes as well. So as I mentioned earlier, we do absolutely no cost, no obligations. If you're interested, Mindy will reach out and follow up off the event. We're delighted to be a resource, great opportunity to learn a little bit more about who we are and how we can help. But more importantly, we'd love to be a resource. Thank you for coming today. Thank you for the questions. If there's anything at all that we can be of assistance with, please feel free to send myself an email or any one of my team members an email. We're happy to be a resource for you. Most importantly, stay healthy, stay safe, and take care. Be well.